the chat box just to make sure everybody knows how to use that. And if you don't already, without a year on Zoom, then I'll be surprised. But if everybody could do that, that would be great. And then we'll get going. So for those of you who don't know me, I'm Katie Fulford-Smith, and I look after the relationships that we have at Big Society Capital with our institutional investor community. So we're one of the leading dedicated social impact investors in the UK, as many of you will know. And we've been working with Pensions for Purpose since the platform launched, and personally since I joined the organisation back in 2018. So we're really excited to be running our first afternoon tea today. So thanks for dialing in. And just to frame this really briefly, as impact investors ourselves, we recognise that the scale of the social problems in the UK are far larger than the capital that we have to address alone. So just tackling the shortage of housing for homelessness alone would require an estimated £24 billion. Now we have proprietary capital to invest of 600 million. So we can't do this alone. And we're encouraged that to date, about 1.5 billion has been invested alongside us, including about 30% of that, which has come from pension fund investors. So with an estimated 1.7 trillion in DB assets alone, we're quite excited by the fact that more and more investors in this space are looking to impact investing, particularly social and affordable housing, and what we can therefore achieve together if we're working alongside you. So I'm going to shortly pass over to the experts in this space of social and affordable housing, my colleagues, Anna and Karen, who many of you know, and they're going to share a little bit about what we have learned over the past sort of 8 years or so investing in this space, and look at some of the subsectors within the homelessness property funds that we think is a great opportunity that's particularly untapped by pension funds. And we hope that we can share some of that experience that we have. We know that many people are either starting on this journey or are some way through it, but as the market's growing, we really want to sort of help others and work with others to invest in this space together. So please keep your sort of curiosity alive whilst we go through the slides and make notes of any questions that you have. We've got about half an hour, hopefully at the end, to have a really sort of interesting Q&A, which Alex is going to lead. So we'll look forward to that. But I'm just going to pass over to Karen Shackleton briefly now. So I'll stop sharing my screen and then try and share it slightly more smoothly again next time.
Thank you, and good afternoon, everybody. So what I thought I would do is just really set the scene in terms of what we are seeing at Pensions for Purpose in terms of some of the pension funds that we've been working with. And I just wanted to start off with this slide, which shows you the trends in pension funds asset allocation. Can everybody see that, first of all? I'm assuming you can. So this is for the local authority pension funds, and I'm aware that corporately we've got other types of investors here today, but it's really just to sort of give you a flavour. You can see that the allocation to property, which is shown by the green bar at the top of each bar, has been gradually increasing over time, and as of March 2020 had grown to around 10% of the average pension funds asset allocation. Just to give you a feel then as to what's been going on in residential property investment, London Borough of Islington Pension Fund have been happy for us to share a case study of their journey towards impact investment. And this started with residential property. Now, this wasn't an impact investment, it was a purely financially oriented residential property allocation. They first invested in 2013, and that was driven by a disappointment over the equity performance that they'd achieved over the previous decade. They wanted to try and get some diversification benefits. They wanted to access the secure income stream that residential property was able to give them. And they also saw a return opportunity in the Southeast, and that was very much what drove their decision as to which manager to appoint. Now, that growing interest in residential property has been sort of coinciding with a growing interest in purposeful investment, impact investment. And here you can see the spectrum of capital. Some of you will be familiar with this. On the left-hand side, you have traditional, purely financially focused investments, and you gradually start introducing more and more purpose into the decision. And gradually, as you go to the far right, you start to reduce the return achievable. So you've got philanthropy on the right-hand side. The impact-driven solutions that we were thinking about for pension funds are those which have that twin goal of delivering a market rate, risk-adjusted return, and an impact goal. Now, at our conference a couple of years ago, we asked pension funds where did they anticipate sitting in 3 years' time for their pension funds. And here's the staggering results. 72% wanted to be investing impactfully in 3 years' time. So a dramatic shift to the right. We've been working with pension funds to help them articulate a set of investment beliefs by using the SDGs, the Sustainable Development Goals. And these are some of the goals that they are prioritizing, which relate very much to social and affordable housing. It can also deliver to reduced inequalities and no poverty. So a number of goals that can be achieved from this asset class, and the middle bunch of those are ones that we have already seen pension funds wanting to bring into their investment beliefs. So that's setting the scene. What I would like to do now is to pass over to Anna Shiel from Big Society Capital to talk in a little bit more depth about this asset class.
Good afternoon, everyone, and nice to see those of you that I know and nice to meet those of you that I'm meeting for the first time. And just to mention before I get into the presentation, if you do have any questions that are sort of bubbling up as we go along, please do pop them in the chat and Alex will help to sort of come back to them during the Q&A. Just briefly, in terms of those of you that don't know me, so I'm Anna Shiel, I'm Head of Origination here at Big Society Capital. I've spent over 8 years here now building out our investment approach in the portfolio, really from the early days when we were just getting going to what you see now. And in the past 3 years, one part of my role has been really building out a dedicated housing team and portfolio, building on some of what we learned in the first 5 years. So just a little bit around who Big Society Capital is. Firstly, as Katie said, we're a leading UK impact investor. And I guess we think there's some distinctive aspects to our approach that I'll just touch on. So firstly, we're focused on contributing to solutions to social issues in the UK. So very pertinently, Karen's just shown the spectrum of capital. We very much position ourselves and see our role as investing in that contributing to solutions category. Secondly, in order to do that, we're multi-asset with a focus on private markets. So as you can see from the chart here, our portfolio spans debt, equity, renewables, and real estate. And finally, as well as being an investor of our proprietary capital, we're also a market creator. So by that, I really mean we often move first in order to create and cornerstone new investment funds and solutions that we think have got the potential to create scalable impact and to develop undersupplied markets. And we also play a wider role in shaping market practices and functioning, for example, through our work on impact management and measurement, as well as engaging with stakeholders, ranging from government, investors, and the social sector. And today, of course, we're going to be speaking really about one of those kind of emerging impact asset classes, social and affordable housing. And we'd like to share some of our experiences from developing this market and also really explore with you your views around how it could and should develop in the future and how that might meet with your own impact and financial goals or those of your clients. So moving on to why we identified housing as a promising impact asset class. Put simply, we think that private capital can best contribute to solutions where there's that crucial overlap between a significant social challenge and also the potential for that to be addressed through sustainable business models. We think housing is a really leading example of that. So the chart here is probably one many of you are familiar with, but it really just shows how that fundamental structural undersupply of housing in the UK has accumulated over the past few years as annual new housing supply has fallen well short of demand. And of course, this shortfall is particularly acute when it comes to social and affordable housing for people with greater needs or on lower incomes. And the estimated backlog, depending on whose estimate it is between 2 to 4 million social and affordable homes that will be needed. Government, as many of you will know, has traditionally been the major provider of capital into this market, bringing in debt finance from banks and from the capital markets alongside that to fund housing associations and local authorities. But a substantial drop in grant amounts since 2010, with grant per unit falling from around 40% to 15%, has meant there's actually a dearth of equity investment. And that was one that we thought that there was a potential for impact-driven investors to have a role in filling. But of course, that would only be true if we thought that the sort of risk-adjusted returns of the sector were potentially a good match for those of the investment community. And we think there's some pretty important characteristics of social and affordable housing as an asset class that make it potentially a good match for longer-term institutional investors like pension funds. Firstly, diversification from other property markets and economic cycles. So the chart here just shows that much lower correlation of social and affordable housing on the right to GDP compared to other real estate asset classes, even including other forms of residential. And the way that social and affordable rents are set is typically decoupled from market forces, resulting in a history of more stable growth. Secondly, government-backed revenues with an inflation linkage. So that's because of the proportion of tenants that are in receipt of housing benefit, as well as the way that the government sets the rents that can be charged to people in social and affordable homes. And together, what that means is that returns are driven largely by long-term stable rental income. The structural undersupply that I referred to on the previous slide and the nature of the housing providers and actually their experience and track record leads to higher occupancy rates, longer tenures than the private rental sector. And that in turn is really supporting an investment model based largely on rental income and modest inflation of capital values rather than development gains. In terms of the returns that we see across the market, there's a bit of a spread. They tend to cluster though around people targeting returns of around 6% total and around 4% distribution yield, but it varies depending on the nature of the housing types and the rental yields and also the leverage in those structures. But putting all of that together, we thought that there was really potential for a significant institutional impact asset class here. And based on that, we made our first investments in social impact property funds focused on housing in 2013. And we've since invested £140 million in 16 funds. And together, those funds have now invested over £500 million and delivered homes to 5,000 people to date. So what's happened since 2013? Well, if we look at 2011, this market didn't really exist. There was virtually no private investment in the sector beyond debt. By 2016, that had grown to 5 managers and £350 million invested. By the end of 2019, when we do our market sizing exercise, there were 13 funds with over £2 billion invested. And the managers spanning impact investing specialists like Resonance to global real estate platforms like CBRE GI. So we think that's pretty exciting growth in a short space of time, particularly when you put it against the backdrop of relatively low institutional investment into residential housing in the UK compared to other countries. But we're not seeing that pace letting up. We ran a request for proposals last year for fund managers and received 19 submissions. And together those were seeking to raise and invest over almost £10 billion. So we've really begun to explore a way that big society capital's role can shift in this market, from seeding a new market and new funds to working more with other investors actually to improve how they can access the impact opportunities that they're looking for. And I think as Karen's slide from earlier really demonstrates the extent to which people are looking for those investable opportunities. So just briefly, based on our experience, I just wanted to share with you a little bit about what we've learned and also some of the themes that we think will be important for the future of the development of the market. I'm very open to sort of talking about and expanding on some of these when we get into the Q&A. So firstly, impact strategies. A combination of diversity and clarity. We're now really starting to see greater differentiation of fund strategies in terms of their impact goals. So for example, we see funds focusing on issues like specialist supported housing for adults with learning disability, but also on affordable private rented sector for key workers. Those that are prioritising and targeting shared ownership and those focusing on homelessness. And we welcome that because we think that firstly, it demonstrates that strategies are increasingly being built around an understanding of social need, which we know is both wide-ranging in terms of who's affected by the housing crisis, but also deep in terms of the extent of the housing and capital shortfall that's involved. Secondly, though, we also think that this specialism will lead to better delivery by fund managers and housing providers of both impact and financial returns, as well as more comparability for investors around performance. But it does also call for more clarity around impact goals and measurement, a more understanding of how investors can contribute to impact in each segment. So to that end, we'll shortly be launching a common impact framework for impact investing in housing, which has been developed in collaboration with a group of leading fund managers. So moving on to fund managers, I guess the question is, can we have the best of both worlds? I touched previously on the fact that the market ranges from impact specialists to commercial real estate platforms. And we've deliberately backed both through our portfolio because we think they bring complementary skills needed to succeed. Understanding of social impact and business models, together with real estate structuring and fundraising experience. But what we're actually now starting to see is some convergence across the market as those impact specialists scale up and as the commercial platforms build their social sector and impact teams. And we think that will be beneficial in mitigating some of the risks that we've seen from the first mover funds, with more commercial new entrants finding deployment slower than expected and impact specialists facing challenges around economies of scale. And finally, when it comes to risk and return, structure really matters here. So there's been quite a lot of debate in this emerging sector around the most appropriate way to structure investments, whether that's between funds and their investees or at the fund level. And there certainly isn't a consensus that we're seeing yet. So lease lengths, which are one of the predominant sort of investment structures being used in this market, can vary from 5 to 40 years and with varying degrees of risk sharing. And there's a mix of open and closed-ended structures as fund managers seek to respond to investors' term and liquidity needs. We believe that the best solutions and those that will ultimately generate the most sustainable long-term returns will balance and align the respective needs and roles of investors and housing organisations. And we're actively working with fund managers to ensure equitable sharing of risk, return and impact. So I'm now going to hand over to my colleague Karen to talk more about the specifics of how this is playing out in one particular impact strategy, homelessness, and also to explore where we're keen to collaborate with you around future market development. Thank you very much.
Thanks, Anna. Hello, everyone. I'm Karen, Investment Director at Big Society Capital. I've been working on the due diligence and management of social and affordable housing funds in the past 4 years. And as Anna mentioned, the sector has really grown significantly in the past few years, from not really existing in 2011 to over 2 billion by end of last year. One of the key subsectors driving that growth are homelessness property funds. And what we mean by that is it's the type of funds that acquires or develops properties for people experiencing homelessness. So today, I'd like to take the opportunity to highlight our experiences investing in this subsector and share with you some exciting developments since last year. So what happened last year? Obviously, coronavirus. Many of us have been asked to stay at home or work from home. But what about those people who don't have a home to stay in? Here are some of the headlines that you may have seen. Coronavirus, all rough sleepers in England to be housed. Government providing hundreds of millions of extra support during the outbreak. As a result, something quite extraordinary happened. The government, together with charities on the ground, mobilized very quickly and brought over 30,000 homeless people indoors to stay in hotels and other types of temporary accommodation. As a result, this joint effort prevented 21,000 infections and hundreds of deaths. But what happens next, and what does that mean for institutional investors? How can we support people to move into more secured and settled accommodation where they can rebuild their lives? We've seen how government and charities have worked together last year to provide rough sleepers and homeless people a temporary place to stay during the lockdown. However, it's not just the public or social sectors that have stepped up. Institutional investors, including Big Society Capital, and a few of you here, have also worked together, collaborating together to provide much needed longer term solutions. Just in the past year, over 60 million additional capital was invested into a range of homelessness property funds. They acquire or develop properties so people can move out of those temporary accommodation into somewhere more settled. I'd like to particularly highlight the involvement of institutional investors. You may see some familiar logos on the left, showing those who made additional capital investment. There are local authority pension funds, such as Greater Manchester Pension Fund and Teesside Pension Fund. There are also combined authorities such as GLA in London and Greater Manchester Combined Authority, as well as different charitable foundations like Joseph Rowntree Foundation and Garfield Weston. So these additional capital is then invested through a range of homelessness property funds, which are managed by experienced fund manager in this space, such as Bridges Fund Management, Social and Sustainable Capital, and Resonance. All of them have operated and established a long track record of working in this space with local authority and charities for many years to house vulnerable people with slightly different models, as well as delivering financial returns for institutional investors. With the next slide, I'd like to share with you some of our experiences investing in homelessness property funds in particular. How do they generate financial and impact returns? And how do we think about risk and return? These models are actually quite straightforward in that the social needs link very closely to the investment drivers that they aim to deliver. There are 4 key points that I'd like to share with you. First, assets. These funds mostly invest directly into high-quality, dispersed residential properties that are already built and scattered in the community. They're not blocks or hostels, but ordinary homes on ordinary streets. What that means for investor is a long-term exposure, typically more than 10 years, into the residential assets that have strong alternative use and therefore strong resale value. Second, income, which we know is a very crucial element of consideration for many of you here. Rental income from many of these funds are linked to housing benefit and more specifically, local housing allowance. This is set by the government regularly to ensure affordability that's benchmarked against local market rent. What that means for investor is that the rental income is visible, is predictable, and it's also government backed, which offers diversification compared to other real estate opportunities, such as commercial properties and private rented sector. Looking at our own portfolio, most of these funds typically offered mid-single digit returns on an unlevered basis. In the past year, thankfully, none of our homelessness property funds have reported arrears or unexpected levels of voids, showing great resilience even during an uncertain market. Thirdly, delivery. We've learned that execution is really key here, as it's not just about providing a roof over someone's head. It's important to select fund managers who have demonstrated multiple years of track record of operating these funds, of supporting tenants. Many of them have worked closely with charity partners to provide both housing and also deliver support that aims to provide better services and improve life outcomes for tenants. Well-managed delivery can help ensure, first, high levels of occupancy to secure stable income, and secondly, to provide investors with a predictable ongoing costs, both of which are key to sustainable financial returns. Finally, impact. Investment into these types of assets are supported by a strong structural demand and supply dynamics. And given the unfortunate growing issue of homelessness, already affecting 300,000 people now, it's an area that has historically received cross-party policy support, and we expect that to continue. This further strengthens the case for its government-backed stability and stable income stream. So to summarize, this is a space that really has grown rapidly in the past few years, with more capital committed and an increasingly diverse range of fund managers to select from, and a growing track record. In the next few years, we believe it has the potential to develop and grow even further, with institutional investors like pension funds playing an increasingly important role. We believe by working together, we can provide the much needed capital that is required to address homelessness and other housing issues, while for investors achieving a sustainable, risk-adjusted financial returns. For us at Big Society Capital, What we would really like to offer is our expertise and experiences. Having committed over £100 million in this space in the past few years, we're now looking for institutional investors who are also looking to create a portfolio of similar housing and homelessness funds. We'd really like to make it easier for institutional investors to invest, whether it's through a single access fund-of-fund type product or other types of structures, or creating something more bespoke for you or your clients interested in the same region or have similar investment appetite. We're really open to explore with you and hear your feedback. So in the next few weeks, we'll be inviting asset owners, investor consultants, and other investors for one-on-one conversations to get to know your views and your preferences better, and your feedback on the overall growth of the market. So with that in mind, I'll hand it back to Alex, who will coordinate the Q&A.
Thank you so much, Karen, Anna, and